big money is not in the buying or the selling, but in the waiting. Ladies and gentlemen, that one line contains the secret that turns small stakes into fortunes. I've seen men with 30,000 accounts panic out of positions that could have made them 100,000. And I've seen others, with the same 1,000, ride a great trend into a lifetime of wealth. Why? Because they understood how to pyramid, not gamble. You must learn, first and above all, never to add to a losing position. That rule, if it is ever broken, will cost you more than you can imagine. I've seen more men wiped out in Wall Street because they couldn't resist the urge to average down than for any other reason. It's a natural human instinct. When something goes against you, you want to make it right by buying more at a cheaper price. You tell yourself you're being clever, getting a bargain, but in truth, you're feeding a sickness called hope, and hope is not a trading strategy. Hope will empty your account and teach you humility in the hardest way possible. When you buy a stock and it drops, the market is speaking. It's telling you, you're wrong, at least for now. And when the market speaks, you'd better listen. If you're wrong, you cut your loss and wait for the next opportunity. But don't ever throw good money after bad. Every dollar added to a losing trade digs your grave a little deeper. When I was a young man in the bucket shops, I made that mistake. I averaged down again and again. Each time I told myself it can't go any lower. But it always could, and it did. I learned that lesson early and painfully, and I've never forgotten it. When you're wrong, get out. When you're right, stay in. And that's the essence of this rule: add to winners, never to losers. Adding to winners is not gambling, it's confirmation. It's discipline. It's letting the market tell you that your judgment was sound. When your trade moves in your favor, it means the tide is with you. That's the time to press your advantage, cautiously, intelligently, with control. I've always said, you must treat a trade like a campaign. You don't send in your whole army at once. You send in a small force, your scouts, to test the ground. If they come back victorious, if they report that the terrain is favorable, then you send in reinforcements. You build your position only when the market confirms your success. That's pyramiding the right way. Each addition should be smaller than the last, because the higher a stock rises, the closer it comes to its natural end. The market breathes. It moves in waves. You must respect that rhythm. Your first buy is your foundation, your next a test of strength, your next an acknowledgement that the tide is flowing with you. But you never double down on weakness. The man who does that is gambling against the trend, and the trend always wins in the end. Most traders fail because they want to be right more than they want to make money. They can't stand to admit they've made a mistake. They say, I'll hold it until it comes back. But the market doesn't care about your pride or your patience. It only cares about direction. The smart trader never argues with the tape. If the price is going down, something is wrong, and your job is to protect your capital, not defend your ego. Adding to a winner, on the other hand, is an act of faith, not in luck, but in logic. It means you understand that profits are proof. When you are right, you press. When you are wrong, you step aside. That's how fortunes are built. That's how small stakes become large ones. I remember a campaign in cotton many years ago. I started small, and when the market confirmed my position, I added. Each new unit of stock was added from profit, not from fresh capital. If the price had turned against me, my loss would have been limited. But it didn't. The move was real, the trend strong, and because I added correctly, the profits multiplied. That's the difference between an amateur and a professional. The amateur tries to buy at the bottom. The professional buys when the market is rising. The market rewards confirmation, not prediction. Anyone can guess. But the man who waits for proof and then acts, that's the man who wins. So when your stock goes up, don't be too quick to sell. Let it prove itself, and when it proves itself again, add a little more. But never, under any circumstances, add to a losing trade. That's the voice of a fool whispering in your ear. There are only two positions a trader should have: right and out. When you're wrong, get out. When you're right, stay in, and if the market keeps proving you right, build your position carefully. That's how pyramids are made. Not from hope, but from strength. If you remember nothing else from me, remember this: the market is never wrong, opinions often are. So stop fighting it, stop hoping. Stop averaging down, trade with the trend, add to winners. That's how you survive, and that's how you grow. You must learn how to build a position the right way. Most traders build towers, tall, shaky, and doomed to collapse. A real trader builds pyramids, wide at the base, narrow but strong enough to stand against the storms of the market. When you pyramid, you're not stacking risk, you're stacking confirmation. The shape of your position should mirror your certainty: large when the market first proves you right, smaller as you climb the ladder of price. The man who builds a tower adds larger and larger positions as the price rises, thinking the higher it goes, the more he should bet. But that man is a gambler. He is chasing price, not following the market, and sooner or later, the market will take it all back. When I build a position, I think of it like constructing a pyramid in the desert. Solid base, smaller stones on top, each level narrower and more deliberate. The foundation is your first trade, your test. You buy a small amount, because at that point, you're not certain. If the market turns against you, you take a small loss and move on. But if it moves in your favor, that's the first whisper of confirmation. Then, and only then, do you add, not recklessly, but with precision. Each addition should be smaller than the one before it. Why? Because as a trend develops, it grows older, not stronger. Every rise brings the stock one step closer to its peak. You don't want to overburden your structure near the top. You want your profits to grow naturally, from the strength of the market, not from your own aggression. A pyramid built this way stands firm because it's built from profits, not fresh capital. Each new purchase is financed by what the market has already given you. That's how you keep risk in check. You're never overextended, never desperate. You're growing from strength, not from hope. I've seen men build towers with borrowed money. They buy more and more as prices rise, thinking they can't lose. And for a while they don't. They make money on paper and they get drunk on success. But the higher the tower, the smaller the foundation. And when the market breathes, even slightly, that tower falls. And when it falls, it crushes them. They forget the first rule of the market: prices move in cycles. And what goes up without reason will come down with vengeance. A pyramid, though, is different. When a correction comes, your base remains strong. Your losses on the smaller top positions are offset by the profits from the lower, stronger base. That's how you stay alive. That's how you grow. The art of pyramiding is the art of patience. You must wait for the market to prove your position before adding. Every layer is earned. The market is not a slot machine, it's a proving ground. The wise trader doesn't fight for every tick. He builds carefully, deliberately, and with respect for the market's rhythm. I remember when I was trading in the early 1900s, I watched men ruin themselves by adding too soon, adding too big. They thought courage was the same as conviction. It isn't. Courage without method is suicide. My method was simple: add only when you have proof, and each addition smaller than the last. If the stock moves 3 points in your favor mount, if it moves 5 more points, add again, smaller still. Never add after it stops confirming your judgment. The market rewards patience and punishes impatience. Building a pyramid takes time. Most men can't wait. They want quick profits, instant satisfaction. They build towers overnight and wake up buried in the rubble of their own ambition. So learn this lesson, Wellesley. Your position structure tells the story of your discipline. A pyramid says you understand the market's language. A tower says you're trying to defy gravity. The first will stand, the second will fall. When you pyramid correctly, your account grows naturally. The profits fund new positions, and your exposure increases only as your accuracy is proven. That's how you turn a modest beginning into something magnificent. Remember, it's not about size, it's about sequence. Each step upward must rest firmly on the success of the one below. That's the Livermore way. That's the way to trade like a professional, not a dreamer. So, when you enter the market, think like a builder. Build your foundation wide and strong. Let each layer rise from confirmation, not from greed. Never try to reach the sky by stacking recklessly. Build with patience, with proportion, with proof. Because in the end, a pyramid endures long after every tower has crumbled to dust. If there's one lesson that cost me more time, more heartache, and more money than any other, it's this: you must wait for the market to confirm your judgment before you act. Most people never learn that lesson. And that's why most people never make any real money in Wall Street. I've seen it 1,000 times. A man studies a stock, he reads all the news, listens to the talk, looks at the charts. Everything looks perfect. He can see the move before it happens. He rushes in. And the market does the exact opposite. Why? Because he acted on what he thought the market should do, instead of waiting for what the market actually did. The market never lies. It's the one voice in the world that tells the truth every minute of every day. But most traders don't listen. They want to be smarter than the market. They want to predict instead of confirm. And that's why they lose. It was never my thinking that made me money. It was always my sitting. I learned that the hard way. Early in my career, I thought quick thinking was the secret to success. That I could outguess the market, jump in early, beat everyone to the punch. And sometimes I was right. But more often I was early, and in Wall Street, early is the same as wrong. The truth is, the market moves in its own time. It doesn't care about your opinions, your research, or your impatience. It moves when it's ready, and your job is to wait for it to show its hand. When it does, you move with it, not before, not after. Waiting for confirmation is not laziness. It's the highest form of discipline. The amateur wants to act. The professional wants to observe. He studies the trend, the volume, the behavior of price. He waits for the market to whisper, yes now. And when that signal comes, he acts decisively. That's what separates speculation from gambling. When I say wait for confirmation, I mean this: don't buy because you think a stock is low or because you hope it's about to rise. Buy because the price action tells you it's rising, because demand has stepped in, because the market itself is validating your idea. The tape doesn't lie. It may not shout, but it always tells the truth to the man who knows how to read it. You see, the market is a living thing. It tests you. It shakes you out. It makes sure you truly believe it before it rewards you. Most men fail the test because they can't stand to wait. They buy too soon, sell too late, and call it bad luck. It isn't luck, it's impatience. I've said it before and I'll say it again: the desire for constant action is what ruins most traders. They think if they're not trading, they're not making money. The truth is, money is made by waiting. The right opportunity doesn't come every day. You must learn to sit on your hands, keep your mind clear, and wait for that perfect moment when everything aligns. That's the moment of confirmation, and that's when you strike. When you wait for the market's confirmation, you're not chasing prices. You're aligning yourself with power. You're putting the odds on your side. A confirmed move has momentum behind it. An anticipated move is nothing but your opinion, and opinions are cheap in Wall Street. Everybody's got one. The tape is what counts. I remember in the great bull markets, I'd watch a stock for weeks, sometimes months. The crowd would jump in early, get trapped, and give up. Then when the real move began, when volume expanded, when price held its gains, when the market confirmed, I'd step in. And because I waited, my timing was right, my confidence was firm, and my profits were large. That's the beauty of patience. It gives you clarity. It keeps you out of the noise. Most of the time, the best trade is no trade. You wait, you study, you prepare. Then, when the market gives you the green light, you act swiftly, decisively, without hesitation. So learn this truth: waiting is not weakness. Waiting is strength. The market rewards the man who can sit tight, who can let others rush in and burn themselves out. Confirmation is your compass. It's what keeps you from walking blindfolded into danger. Don't predict, confirm. Don't guess, observe. Don't rush, wait. Because in this business you can be right and still lose if your timing is wrong. But if you wait for confirmation, the market itself will carry you to victory. Patience is not just a virtue in trading. It's the difference between a quick fortune and a quick ruin. So sit tight. Wait for proof. Let the market speak first, and when it does, listen. That's the Livermore way. There's one truth in Wall Street that separates the professionals from the amateurs. A trader's first duty is not to make money. It's to keep it. I've seen men with brilliant ideas lose everything because they didn't understand risk. They could read the market, but they couldn't read themselves. They wanted to be rich so badly, they forgot the one rule that matters most: protect your capital. You can't play the game if you've lost your chips. People talk about opportunity as if it's something you chase. They say, I'm going after this stock. I'm going after that trade. But opportunity doesn't reward the man who chases. It rewards the man who's ready. And you're only ready when your risk is under control. Every trade you make should start with one question: how much can I lose if I'm wrong? If you can answer that and accept it, then you can trade with confidence. But if you can't answer it, or worse, if you ignore it, then you're not trading. You're gambling, and the market doesn't forgive gamblers for long. When I put on a trade, I think about risk first, profit second. I never assume I'll be right. I plan for what happens if I'm wrong. That's why I use stops. That's why I size my positions carefully. The man who trades without limits is already finished, even if he doesn't know it yet. Risk control isn't fear. It's respect. Respect for the market. Respect for your capital. Respect for yourself. I've watched men double their positions to make back losses, chasing the ghost of the last trade. They don't realize they're digging their own graves. The market gives you chances, yes, but it doesn't give you mercy. If you want to expand opportunity, start by narrowing your risk. Keep your losses small, deliberately small. When you take a loss, take it quickly. Don't argue with the tape, don't rationalize. The market is always right, your opinion isn't. The moment you learn that, you become dangerous. Because now you can survive long enough to win. When I built my fortune, I never thought in terms of how much can I make. I thought in terms of how little can I lose. The difference is everything. The trader who focuses on profits takes reckless chances. The trader who focuses on risk takes controlled ones. The first man may get lucky once or twice. The second man stays in the game for life. And here's the great irony: when you control risk, you actually expand opportunity. When your capital is safe, you can wait for the big moves. You can hold your winners longer, pyramid your profits, and strike harder when the odds are in your favor. You have flexibility. And in Wall Street, flexibility is freedom. You see, most traders lose not because they're wrong. Everyone is wrong sometimes, but because they stay wrong. They can't admit it. They freeze when they should cut their losses. The professional does the opposite. He cuts his loss without emotion and moves on. He knows there will always be another trade. The market never runs out of opportunities, only traders who run out of money. Controlling risk is about humility. You must accept that the market knows more than you. It always does. The moment you think you've outsmarted it, you're finished. That's why I never argue with prices. If a stock is falling, it's falling for a reason. I may not know the reason, but I don't need to. The tape is all the evidence I require. When you trade with discipline, your account becomes your fortress. Small losses are the cost of defense. They're the price you pay for protection. And once you have that protection, you can seize opportunity when it comes. Boldly, confidently, without fear. That's how fortunes are made. The trader who refuses to control risk lives in fear. Fear of every tick, every fluctuation. The trader who masters risk lives in clarity. He knows that one good move can pay for 10 small losses. That's the beauty of this game. You don't have to be right all the time. Just right big when you are. So remember this, the goal is not to avoid losing. Losses are part of the business. The goal is to keep them small enough that they never threaten your survival. Protect your capital first, and the profits will take care of themselves. Opportunity is a reward, not a right. You earn it by managing risk. The market opens its doors only to those who are prepared, disciplined, and patient enough to wait for the perfect time to strike. And when that time comes, when the tape confirms when the setup is perfect, you go in with confidence, because you know you've done the hard part already. You've protected yourself. That's how you last. That's how you grow. That's how a trader becomes a legend, not by swinging for the fences, but by guarding his base and letting his winners run. Control risk, expand opportunity. That's the Livermore way. There's one phrase I've repeated more times than any other, and I'll repeat it again because it's the foundation of everything I ever learned in Wall Street. It was never my thinking that made me the big money. It was always my sitting tight. That's where the real fortune lies. Not in the buying, not in the selling, but in the waiting. Every fool can buy a stock, and every coward can sell one, but it takes a man of steel nerves and quiet conviction to sit through the noise and let the market pay him. Most traders can't sit still. They need action. They buy one day, sell the next, and call it trading. But they're not traders. They're speculators chasing excitement. They don't realize that the market rewards patience, not movement. The big money, the kind that turns $1,000 into 100,000, is made by catching a major move and sitting through it. I've seen men ruin perfect positions because they couldn't resist the itch to tinker. They take small profits, feeling clever, and then watch the stock run another 50 points without them. They'd sell too soon because they feared losing what little they had, not understanding that the market was just beginning to confirm their brilliance. When you're on the right side of the market, truly on the right side, your greatest weapon is stillness. You must silence the urge to act. You must sit through the fluctuations, the dips, the rumors, and the fear. Every great trend tests your patience. It shakes you, it tempts you to quit. But if you know you're right, you sit tight. You see, the market always gives you a chance to get out wrong, and only one chance to stay in right. The weak trader listens to his emotions. The strong trader listens to the tape. The tape will tell you when the move is over. Until it does, your job is to hold. I remember one campaign in the old days. I was long in a stock that was moving beaut as the trend was perfect. But every few days there'd be a shakeout, sharp declines, terrifying drops. The newspapers would scream, the crowd would panic, my brokers would call nervous. But I held my line. I'd studied that market. I knew the move wasn't done. I told them, it's just the market breathing, and that weeks later that position paid me more than any 10 quick trades could have. Why? Because I waited. Because I sat tight on the right side. People think trading is about being right. It isn't. It's about staying right. You can catch the best move in the world and still walk away with nothing if you don't hold your position long enough. The amateurs make small profits and big losses. The professionals make small losses and big profits. The difference is patience. Now, don't misunderstand me. Sitting tight doesn't mean blind hope. You must sit only when you're on the right side. When the tape proves you're wrong, get out immediately. But when the tape proves you're right, don't be shaken by fear or greed. Let your profits run. The market will always test your resolve. It will tempt you to grab a little profit, whisper that the move is over. It'll make you doubt yourself just before the real move begins. The man who yields to that whisper will always end up watching others make the money he should have made. The man who sits tight, who trusts his plan, his pyramid, his judgment, will reap the full reward. Sitting tight is not easy. It's the hardest discipline in the business. It's easy to buy, it's easy to sell, but to do nothing, to simply wait calmly while the market unfolds in your favor, that takes strength. It takes faith in your method, confidence in your risk control, and courage to stand against the crowd. Every great fortune I ever made came not from my entries, but from my holds. I've had thousands of trades, but only a handful made the big money. And in each of those, I did one thing: I sat tight. There is only one side to the market, and it is not the bull side or the bear side, but the right side. Once you're there, your only job is to stay there. The market's great secret is time. Time multiplies profits, compounds judgment, and tests patience. The man who can master time can master the market. So when you find yourself on the right side of a great move, don't ruin it by acting smart. Don't let the noise shake your conviction. Sit tight, hold steady, trust your position. Because in the end, the market rewards not the clever, not the lucky, but the man who can wait while everyone else panics. Sit tight. That's how you turn a trade into a fortune. That's how 1 Zalosen becomes 100 Zalosen. That's how you win the game. The market is a mirror, my friends. It reflects your patience, your discipline, your courage, what you haven't earned, and take everything you don't respect. So, build wisely, trade patiently, and when you find yourself on the right side, sit tight and let the market make you rich. Or, if you want a shorter, punchier version to close with impact, like the final line of a stage speech, don't chase the market. Don't fight it. Learn its rhythm, trust your judgment, and sit tight, because the big money waits for the man who